Most people encounter credit for the first time in a reactive way. They apply for an apartment and get told their credit is insufficient. They try to finance a car and discover that the interest rate they are offered is significantly higher than what was advertised because of their credit score. They apply for a credit card and get declined. The first meaningful interaction with the credit system is often a moment where it is already working against them, and they do not fully understand why or what they could have done differently. This video addresses that by starting from the beginning. What credit actually is, how the credit system is structured, why lenders use it, and what it means for your financial life going forward. Credit, in its most fundamental definition, is the ability to borrow money or access goods and services with the agreement that you will pay for them later. When a bank approves you for a loan, they are extending credit. When a landlord allows you to move in before you have paid the full month's rent, that is a form of credit. When you use a credit card to pay for a purchase and receive a bill at the end of the month, that is credit. The common element in every form of credit is deferred payment. You receive something of value now, and you commit to providing something of value, typically money plus interest at a future date. The reason credit exists as a system rather than simply as individual agreements between borrowers and lenders is that assessing the risk of lending to any given individual requires information. A bank considering whether to lend you $50,000 for a car needs to make a judgment about the likelihood that you will repay that loan as agreed. They cannot make that judgment based on a conversation or a gut feeling, at least not reliably or at scale. What they need is a standardized record of how you have handled debt obligations in the past. That is what the credit system provides. It is a standardized infrastructure for collecting, storing, and communicating information about your borrowing and repayment history so that any lender can assess your creditworthiness efficiently and consistently. The infrastructure of the credit system in the United States is built around three major credit bureaus: Equifax, Experian, and TransUnion. These are private companies whose business is collecting and maintaining credit data on hundreds of millions of consumers. Lenders, including banks, credit card companies, mortgage lenders, auto financing companies, and others, report information about their borrowers to the credit bureaus on a regular basis, typically monthly. That information includes whether the borrower opened a new account, what their credit limit or loan amount is, what their current balance is, and most importantly, whether they made their payments on time. The credit bureaus compile this information into credit reports, one per bureau per consumer, and make those reports available to lenders who are considering extending credit to that individual. Credit scoring companies, primarily FICO and VantageScore, take the data in your credit report and run it through a mathematical model that produces a three-digit number representing your creditworthiness. This number is your credit score. Different lenders use different scoring models, and your score can vary slightly between bureaus depending on which data each bureau has on file, but the underlying logic is consistent. The score is a shorthand representation of the information in your credit report, designed to make lender decision-making faster and more standardized. A higher score indicates a lower risk of default from the lender's perspective. A lower score indicates higher risk, which typically results in higher interest rates, lower credit limits, or denial. The practical implications of your credit profile extend significantly beyond your ability to get a loan. Landlords in many markets routinely pull credit reports as part of the rental application process. A thin credit file or a negative credit history can result in being denied an apartment, being required to pay a larger security deposit, or needing a cosigner. Some employers, particularly in finance, security, and government roles, pull credit reports as part of background checks. Utility companies sometimes check credit and may require a security deposit from applicants with no credit history or poor credit. Insurance companies in many states use credit-based insurance scores when setting auto and homeowners insurance premiums. The reach of the credit system into areas of life beyond direct borrowing is broader than most people realize. Understanding credit also requires understanding the difference between credit and cash from a functional standpoint. Paying with cash or a debit card does not build credit history. Those transactions do not get reported to the credit bureaus because there is no debt involved. The credit system only tracks borrowing and repayment. This means that someone who has always lived frugally paid for everything with cash and never borrowed money has no credit history. And from the perspective of any lender or institution using credit data, they are invisible. An absence of credit history is different from a good credit history. And in many situations, it produces similar outcomes to a poor credit history because the lender has no data on which to base a positive assessment. Building credit, therefore, requires using credit products and handling them responsibly, even if you prefer to pay cash for most things. Starting with no credit history is an extremely common situation, particularly for young adults, recent immigrants, and anyone who has not previously engaged with the credit system. It is not a penalty or a reflection of financial irresponsibility. It is simply a starting point. The credit system has no memory of you yet, which means you're building a record from scratch. The important thing is to understand the starting point clearly so you can approach credit building deliberately rather than accidentally. The specific strategies for building credit from zero or from a negative position will be covered in a subsequent video. What matters here is that the starting point is understood and that the process of establishing credit history is seen as an intentional part of building a functional financial life rather than something that happens automatically. It is also worth addressing a common misconception early. Many people believe that carrying a balance on a credit card, meaning not paying it off in full each month, is necessary or beneficial for building credit. This is false. Carrying a balance does not help your credit score. It costs you money in the form of interest charges. Paying your credit card balance in full each month is both better for your credit profile and significantly cheaper than carrying a balance. The misconception likely persists because people conflate using credit with owing money, but the credit system rewards responsible use of credit products, which means borrowing and repaying on time, not maintaining ongoing debt. Another misconception is that checking your own credit score hurts your credit. This is also false. There are two types of credit inquiries: hard inquiries and soft inquiries. A hard inquiry occurs when a lender pulls your credit report as part of an application for new credit, such as a credit card, loan, or mortgage application. Hard inquiries have a small, temporary negative effect on your credit score and remain on your credit report for 2 years. A soft inquiry occurs when you check your own credit, when an employer or landlord checks your credit for screening purposes, or when a lender checks your credit for pre-approval purposes. Soft inquiries do not affect your credit score at all. Checking your own credit report regularly is not only harmless, but actively useful because it allows you to monitor for errors and unauthorized accounts that could be affecting your score. The Fair Credit Reporting Act, commonly referred to as the FCRA, is the federal law that governs the credit reporting system in the United States. It establishes your rights as a consumer in relation to the credit bureaus and the information they maintain about you. Under the FCRA, you have the right to obtain a free copy of your credit report from each of the 3 major bureaus once every 12 months. Through the official website, you have the right to dispute any information in your credit report that you believe is inaccurate or incomplete. The bureau is required to investigate the dispute within 30 days and correct or remove any information that cannot be verified. You also have the right to know if information in your credit report has been used to take an adverse action against you, such as denying a loan application, and to receive a copy of the report that was used. Credit is one of the few financial systems where your history follows you in a formalized and consequential way for years. Negative information, including late payments, collections accounts, and most derogatory marks, stays on your credit report for 7 years. Bankruptcy can remain for up to 10 years, depending on the type. This long retention period means that financial decisions made early in life, particularly decisions involving debt and repayment, have lasting consequences that are not immediately apparent at the time. Building good habits from the beginning, or repairing damaged habits as quickly as possible, is substantially easier than recovering from years of negative history once it is established. The foundational principle of credit, stripped of all complexity, is straightforward. Borrow money when necessary. Repay it on time and in full whenever possible. Keep your outstanding balances low relative to your available credit, and avoid applying for new credit more frequently than your financial situation genuinely requires. That set of behaviors, applied consistently over time, builds a strong credit profile that opens financial doors rather than closing them. Everything that follows in this module builds on that foundation.